Good afternoon and a very warm welcome to all our esteemed guests. I am Manish Mehrotra, Zonal Head Product Management of IC Securities, and I'll be your host and moderator for today's event. We are very excited to present to you the session on how to decipher Union Budget 2025 and its impact on Indian market. In today's event, we'll have our first session by none other than Mr. S. Naren, CIO of ICICI Prudential AMC, followed by session by Mr. Pankaj Pandey, Head of Retail Research at ICICI Securities, and then we'll have a brief session on unique ICICI Direct advantages, and finally we'll have Q&A session. To begin with, it is my pleasure to introduce our first speaker, Mr. S. Naren. S. Naren is a prominent figure in the world of finance, renowned for his expertise in investment management. As the Executive Director and Chief Investment Officer of ICICI Prudential AMC, Naren oversees the management of various mutual funds, schemes, and plays a pivotal role in shaping the investment strategies of the company. He is widely respected for his astute market analysis, risk management skills, and ability to navigate through diverse market conditions. With a distinguished career spanning over 3 decades, Naren had established himself as a seasoned investor and strategist. He is known for his pragmatic approach to investing, often emphasizing the importance of value investing and asset allocation. Throughout his career, Naren has received several accolades and recognition for his contribution to the financial industry. He graduated from Indian Institute of Management, Kolkata, and he has done his engineering from IIT Madras. Overall, S. Naren profound knowledge, strategic insights, and commitment to excellence has cemented his position as one of the leading investment professionals in India. So, sir, I'm very pleased to welcome you to share your views on the budget with us.
Welcome to all of you. I hope I'm audible and clear. Uh, Actually, the budget over the last 30 years have become simpler and simpler because what has happened is that GST Council has taken away all the excise duty changes. All the excise duty changes, those kind of changes all happen from the GST Council. And in 90s, our tax rates used to be very high. So every year the budget was a widely sought after event because we had a situation where the customs fees used to come down and tax rates used to come down. But after the rates came down in 90s, it was impossible for rates to come down further. So actually the budget is not an event which can actually shake everything because at the end of the day we have
Sir, you may have to switch off your camera. Volume is not coming very clear.
Change. Now, to change things so drastically every year. So this year's budget, if lower income bracket substantially, and this was one of the most welcome changes that we needed in the economy. What had happened is this government has always been very, very prudent in macroeconomic reasons. So we had very good fiscal deficit, very good current account deficit, very good control on inflation. But what happened? And we also had a lot of amount of money spent on infrastructure. But in this whole process, what happened was a lot of people who were in the lower income group did not have enough money to spend, with the result that many of the consumer facing industries like FMCG, two-wheelers, many of the lower value cars, and many of those kind of industries, QSR, many of those industries had done very badly over the last 3 years because bulk of the tax actually came from them, and a lot of tax increase happened because of better compliance. Again, because the government actually did a very good job of tax compliance. And what was needed was that you had to reduce tax rates on the people at the lower income group. And if they did that, it would be a very, very big upside to the entire economy. So what the government did in this budget was actually provide a good tax benefit to all the people in the lower income group, particularly people with an income of less than 12,75,000 rupees per year. And this was a fantastic step done by this in this year's budget. Frankly, that was the only big change in the entire budget. Now, what will happen as a result of that is that we expect that the incomes will go up in that group. And when that income goes up in that group, given the nature of the people in that group, that income is most likely to be consumed or it will be used to repay borrowings. And if it is used to repay borrowings of, let's say, personal loan or something like that, that will also be a welcome step. If it is used to increase consumption, that is also a welcome step. Both these steps will give a huge boost to the economy, and that will be a very, very welcome positive. So, overall, I would say this is a fantastic budget from the point of view of what is needed in the economy. And because of that, we are expecting a big benefit. Now, where is the challenge in the budget? Where the challenge is not in the budget. After this tax concession, which is rumored to have costed 1 lakh crores, according to what the finance minister told us today, the honorable finance minister, I would say that clearly the fiscal deficit could be higher than what has been budgeted. We are believing that it could be slightly higher. It could be 4.4%. It could be slightly higher. It just does not matter because there has been very good fiscal consolidation on the part of the government of India over the last 3 years. That whether it is 4.7 or 4.4 does not matter. We have brought it down from almost 9% in 2020-21 to 4.7. That it is a welcome step to reduce the fiscal deficit in the last 4 years. That is a welcome step. That whether it is 4.4 or 4.7 hardly matters in our opinion. So we believe that this fiscal stimulus that has been given by the government of India is a very welcome step. Now, what are the challenges? The challenges are in the market. The market has still, after the correction seen in January, the small and mid caps look overvalued. It is not that it is cheap even today. And even today, if you look at many of the stocks in the small and mid cap, they do look overvalued. And even today, many of the IPOs which come at this point of time do not come always reasonably valued. That is a challenge at this point of time. So whether it is small cap, whether it is IPO, or whether it is mid cap, that area of the market is clearly overvalued at this point of time. And that is a risk that we are seeing at this point of time. And that risk has not gone away after the budget. Did it have anything to do with the budget? The answer is no. Is the situation better than where we were in September 30th? The answer is yes, because there has been a correction in the market after September 30th. But the problem has not gone away in the budget, thanks to the budget, because budget cannot solve these problems. The market valuation correction only can solve the problem. Can this problem go away with time? The problem can go away with time. As it is correcting. Uh, on the large cap side, the problem is much smaller than what it is. And we are not big believers that the large cap correction can be very significant from here. And we believe that in case that the dollar index actually reduces, the large cap problem may be over. I'll come to that in a minute. But that is the situation as far as large cap is concerned. But on the small and mid cap side, even today, the market looks overvalued. And that risk exists in investing in small cap and mid cap at this point of time. How do we look at it? We look at it by looking at the trailing price to earnings ratio of many of the stocks. So we look at the earnings per share of the companies, we look at the price and take that different division. And we find that even today, the small and mid cap area of the market looks overvalued at this point of time. And that is the challenge we find in the market. And that problem has not gone away. What has happened in large cap is important for you to know. What happened after September is that there was the Trump election. And because of the election of Donald Trump and the fact that he wanted a situation where he is going to bring tariffs, there has been a huge amount of money sold by FIIs in the large cap area. And that money has gone away to the US market. So they have sold so much of large cap stocks. So due to that, what has happened is the large cap stocks have become much, much more reasonably valued at this point of time. Can this correction continue? This correction can continue, particularly if the dollar continues to appreciate against all the currencies in the world. And it is impossible for anyone at ICICI Prudential Mutual Fund to know whether it will continue, because the correction is not because of India, not because of anything that India did, not because of any Indian company, but because of the fact that dollar keeps appreciating on a continuing basis. And that is the reason this correction has happened on a continuing basis. And that can continue even today from here also, if we have a situation where the dollar keeps appreciating. But our view is at some point of time, the dollar will start depreciating. And once dollar starts depreciating, FIs will start investing in this country back. And when they start investing in this country back, we believe that large caps will start getting the money. So, which is the reason we believe that it may already be time for people to start considering large caps. How to invest in large caps is something we find it difficult to say, but at least if you ask me from a valuation point of view, they are not very overvalued. We are in a situation where the sentiment factor is also saying that one should start nibbling on large caps at this point of time. And that is what the market is telling us at this point of time from a large cap point of view. The risks are all due to what is happening on US policy. And because we can't understand US policy, it becomes very difficult for us to say how long this large cap correction will last. But we believe that already it has come to a situation where nibbling in large caps should be considered. Are we worried about the Indian economy per se when we speak about this? The answer is no. The budget has done a good deal to ensure that the consumption side of the sector, which was slowing down, will not slow down to that extent. It can actually start improving. That you would have seen in all the sectors which did well today. Today, for example, FMCG sector did well, auto sector did well, retailing sector did well, the QSR sector did well. All the sectors connected to the consumption part of the economy did well at this point of time, which means that the entire economy is likely to do better than what would have happened if this amount of fiscal stimulus had not been given. So we are overall in a situation where I would say things are reasonably good from an India point of view on the large cap side. How should investors invest? We believe that investors should not be leveraged in this market by investing in equity. One should be careful when they are investing in the derivatives part of the market. One should be careful if they are over invested in small and mid cap in the market. One should be comfortable if they are investing gradually in large caps in the market. And that is the reason what we have been doing at ICICI Prudential is to recommend asset allocation and recommend investing in hybrid funds in the market and recommend systematic transfer plan in large cap or in flexible equity funds in the market, which invests in all categories at this point of time. Overall, the result season is possibly two-thirds done. Now, people ask me, why is the market very volatile in the result season? Suddenly, one stock goes up substantially, another stock goes down substantially. The reason is there is too much of hedge fund activity in the market. This is what people tell us. I don't have any first-hand information. But due to this amount of hedge fund activity in the market, what happens is every result, there is buying and selling after the result due to positioning by various hedge funds, is what people tell us. There is nothing to do with the fundamentals of those stocks in the market. So I think you should ignore the volatility in the results after the result or before the result. There is anything worry about the volatility in the market at the time of the result. I believe there is nothing to fear due to the volatility. So overall, macro is fine. Valuations in large cap is getting attractive. And if you ask me, the budget is improving the trend in the economy. So overall, I would say everything is going in the right direction for long-term investment. But if people take wrong decisions in the form of being very leveraged, the chances of losing money exist at this point of time. You'd have seen that 2 weeks back in the market when there was a big fall in many of the stocks. It was mainly because I think there were a lot of leveraged investors in the market, because the mutual funds, which are not leveraged investors and were systematic investors, had no problems per se. But the market saw at that point of time fairly volatile environment, and it had funds use the opportunity, I think, to buy in that correction. And that is what you would have seen in the form of domestic institutional investor buying in each of those days when the market fell at that point of time. So that is where we are. And so to sum up, I would say that the budget was a very good budget. There were a lot of small announcements. Those small announcements which have been done by the government are very good directionally. But are they important to change the sentiment of the market? I don't think so. The last announcement that the finance minister did on taxation is the only announcement which has the potential to change the market, which is the taxation announcement. And the taxation announcement is the one which is really beneficial to the market. And other than that, all the other announcements that have been done are all very good procedural announcements, which are important for changing India and giving that fillip to agriculture and various other important things which are important for India. And I believe if you don't do all those things, we are not going to see that 100 years of independence and a Viksit Bharat that the government is trying to focus on. That is how I see it. Broadly, that is what I wanted to convey. And I would be very happy to now hand it over to Pankaj, I think, who will be in a position to take it over from me and explain at length what are the opportunities which are there at this point of time for investing, and then hand it over to on what are the opportunities that ICICI Direct is going to give you. That's how I look at it. And over to you, Pankaj. Thank you, ICICI Direct team, for giving me the opportunity to talk to all of you. And we at ICICI Prudential are grateful to ICICI Direct for giving us the opportunity to talk to all of you on the budget. Thank you.
Thank you, sir. Thanks for this comprehensive detailed insight. Uh, Now I'm pleased to introduce you to our second speaker for the event, Mr. Pankaj Pandey. I'll just give you a brief profile of Pankaj. Pankaj heads the retail research at ICICI Direct. He's associated with ICICI Securities for over 2 decades and has led the research desk since last 16 years. The research team consists of 40 plus members and is further segregated in fundamental, technical, derivative, and MF. Under his leadership, the ICICI Direct research team tracks over 250 companies across sectors in the large, mid-cap, and small-cap universe. He also leads the technical and derivative desk, which boasts of an envious track record in terms of short-term trading calls. Pankaj is an MBA from ICFAI Business School and he is also a CFA. I now invite Pankaj to share with us his budget analysis and his findings on the budget. Pankaj, over to you.
Yeah, thanks, Manish. Good afternoon, all. Pankaj this side. Before I come to budget, a bit of a background in the market. So if you all recall or have seen the markets till September, the markets was sitting on a gain of about 20-22 odd percent. Subsequent to that, the market lost half of the gains, especially the large caps. The cut in the mid cap and small caps was even more steeper. That is largely to do with the fact that as and when the market realized that Trump is about to come in, the volatility started to seep into the market. And largely what was coming out was that Trump is going to hike tariff, which is what he has been talking all along. And he'll be going with a tax rate cut, especially in for US companies. And as a result of that, money started to sort of flow back to US, and which is why the dollar index started to sort of climb, and a lot of emerging market, including ours, witnessed a good amount of selling pressure. Just to highlight, since October, we have seen a selling of in excess of about 2.2 lakh crores. So which is one of the highest selling which we have seen. Thanks to domestic inflows, the market has not seen the kind of historical correction whenever the FIs selling has been to that extent. So while that was one of the reasons, the other reason was that when you look at the first half of this year, first half, the growth rate or the EPS growth rate for Nifty companies was about 5%. And this was coming on a very high growth rate of about 20% a year before, which is FY24. This lower growth rate was because of three reasons. One, we had 8 state elections, and on top of it, you had Lok Sabha elections as well. So that led to sort of a capex slowdown, and as a result of that, the overall GDP growth got impacted. Now, our sense is that in the second half, overall, this capex is expected to sort of pick up. When you look at the budget, now, for example, for the first 9 months, so just to give you a context, last year the budget figure for overall capital expenditure was 11.1 lakh crore. But what we have seen in the month or last 9 months is a capex of about 7 lakh crores. And what the budget has revised it downwards to is from 11 lakh to 10 lakh crores. So 1 lakh crore kind of a cut. And so what is expected is that next 3 months, which is Jan, Feb, and March, we are going to see a capex of about 3 lakh crores. Now, on top of it, the budget for next year, what it is penciling is a overall capex of about 11 lakh crores. So which means that the overall capex momentum is going to be sort of sustained, while the market was expecting bit sort of a higher number. Largely because of the perspective that, see, in terms of in today's market condition, it is not expected that the private sector capex is going to pick up big way, largely because of the global uncertainties. And which is where it was expected that government had to do two things. One, they had to sort of increase the overall capex. And the other thing was that, like Naren highlighted, was that the consumption, especially coming from the middle class, was impacted. So that was another concern which the government had to address. And on top of it, the other concern was that you can't really let go the fiscal prudence which the government has adopted for a long period of time. So this budget was all about consumption push and fiscal prudence. So when you look at consumption push, largely it has been is being driven through personal income tax benefit, which the FM announced. And on the fiscal prudence side, so while the fiscal deficit for FY25 initially was 4.8, the budget got it revised to 4.8. And for next year, it's down to about 4.4%. So clearly the highlight of this budget is the consumption push, and the other is the fiscal prudence. And coming to the capital expenditure part, like I said, the last 9 months, the capex has been softer. So from that perspective, relative growth is still quite good. So from that overall sense, is what we are getting is that while it is really not up to the market expectation, because market was, in fact, we had this expectation that at least a 20% kind of a capital expenditure growth was expected. So from 10 lakh crore to about 12 lakh crore. What the government has come up with is about 10% higher, which is 11 lakh crore. So a bit lower, and which is why you see the reaction in the market, especially the capex oriented stocks taking a sort of an impact. But like Naren highlighted, see, in economy, you need to sort of balance all stakeholders, and consumption was definitely taking some impact, and which is why there has been a focus there. Now, on the consumption side, overall, exemption on the personal income tax up to 12 lakh crores, and also the addition of new tax slab, I think is going to lead to better income in the hands of middle income group. And on top of it, there are other measures to sort of allocations have gone up to sort of improve the rural economy. And this is definitely going to boost the sentiment, especially on the urban and the rural demand. Because when you look at a segment like, say, FMCG, now in FMCG, the overall growth has sort of touched a low of about 2% in Q3. And while rural consumption or rural FMCG volume was doing good at mid-single digits, but I think with this good support, what has come in the budget, we would expect rural growth to improve further going forward. So it is definitely positive for consumer staple companies, and also from the perspective that the Mahakumbh is going on. So obviously that is another leg which can help these companies to sort of deliver better set of volume. The other good thing was in the budget from a FMCG perspective was that every year there is always a fear that the budget is going to increase the cess or tax rates on cigarettes. Now, from that perspective, there has been no change. And what it is going to do is that it is going to lead to better market share for the listed companies. And in fact, we would expect ITC cigarette volumes to sort of grow in the range of 3 to 5%. In addition to that, some more basic changes have seen in the budget. So, for example, basic custom duty on sorbitol has been reduced from, say, 30 to 20%. Now, this is one of the key raw material which is used in the manufacturing of toothpaste, and definitely positive for companies like, say, Colgate, Palmolive, Dabur, or HUL. In addition to that, there are some synthetic flavoring essences or essence where which are used in the foods and drink, where also the customs duty has been brought down from 100% to 20%. And positive for again companies like say Varun Beverages, Dabur, Nestle, and Tata Consumer. Similarly, besides consumer staples, the consumer durable as a segment is also going to sort of benefit. And our sense is that discretionary home appliances companies, so for example, companies operating in the room air conditioner, lighting and fixtures, fans, refrigerators, I think these are urban centric. They could get a good growth impetus from this recent sluggish scenario what we have seen. So you have companies like Havells, Crompton, Blue Star, or Voltas, which are expected to be benefit. In addition to that, the government has corrected the inverted duty structure, which was there on the flat panel. So custom duty has been increased there from 10 to 20 odd percent. So again, this is going to push more for Make in India and definitely positive for a lot of these companies which are into contract manufacturing, like say something like Dixon. Similarly, for a segment like real estate, I think overall sense is that while when you look for or when you lower the fiscal deficit, what it does structurally to you is that the crowding out effect is relatively lesser. It also gives RBI a lot of comfort to cut rates, and a lot of interest rate sensitive segments, be it real estate or be it infra, tend to benefit from this because your cost of equity comes down, and which again is a positive for the overall banking as a pack, and also the companies which consume working capital or fund flows. So from that perspective, it is definitely positive. And in addition to that, what the government is also looking to do is that they've allocated about 15,000 odd crores for projects which were stuck. So they are looking to complete about 1 lakh units which have been there. And I think there's been some bit of announcement on the pharma side. So healthcare, obviously the Ayushman Bharat has got an allocation hike of about 24%. Which is definitely good thing for hospitals overall. And on top of it, there has been some reduction in duties for the life-saving drugs and the APIs which are used for manufacturing some of these drugs used in cancer or for rare diseases. So these are some of the positives which have come in from the consumption perspective. Now, while there is, like I said, market is really not liking the fact at this point in time that the overall capex spend is about 10% higher. When you look at historically last 4-5 years, the CAGR for capital expenditure increase has been about 20 odd percent. So from that perspective, this is lesser. But I think one needs to notice that the last 8 to 9 months, the capex has not been so high. So from a lower base, we could still be seeing a good amount of increase. And which is why our sense is that while the market is not really liking this in the near term, and which is what you see the reaction in the market for most of the stocks. But our sense is that somewhere down the line, if we get a comfort from the government that once we are able to consume this allocated money, in case if they are able to sort of give comfort in terms of providing further money for capex, I think that is what the market would have liked. And I think one more thing is that, when you do a capex, if you are spending 100 rupees as a capital expenditure, the multiplier effect it does is quite significant. So you get about 300 rupees on the GDP side. Whereas when you are spending, say, about 100 rupees on the say direct benefit transfer or passing on direct benefits, what you get in terms of benefit is about closer to 100 odd rupees only. So which is why infra push is definitely a big ask from the government. And from a lower level or from a lower capital expenditure first 9 months, these are decent allocations. But nevertheless, markets have been sort of disappointed a bit. And again, when you look at some of the components there, the road and railways, the biggest component, those have not seen much of a change. So FY25 road allocation was 2.72 lakh crores. It is largely the same. Similarly, the railway was 2.52. It is largely the same. Defense, the overall allocation has gone up by about 13 odd percent. And rightly so, because the government is clearly realizing the need. And when you look at it, they say, for example, a segment like defense, one I think the capital outlay for space sector has gone up by 30 odd percent, because what the government is looking to do is create a space economy, and which is expected to grow 5x in the next 10 years. Similarly, shipbuilding is another segment which requires good amount of effort, and which is why ship recycling credit note scheme has been sort of announced. And obviously, this is expected to address the cost disadvantage which in domestic manufacturing, which is what a lot of companies have been highlighting. On top of it, about 25,000 odd crores have been provided for Maritime Development Fund. There are a number of measures taken on the capex side and in the right places, I feel. So from that perspective, it's not a big disappointment the way markets have sort of reacted. Overall sense is that from a budget perspective, I think while the budget is right in the direction as Naren also highlighted, I think what also needs to be watched for the next 1 month or two is that the kind of tariff or the kind of announcement Trump does and potential impact it has in terms of the FI inflows and outflows. And which is why I think markets can remain volatile for some period of time. But having said that, I think once these issues settle down, domestically, the government has addressed one of the core concerns, which is the consumption side, and also while at the same time not really letting go of the fiscal prudence objective, which again has a lot of structural benefits in the long term. So all in all, this budget is a sort of a step in right direction, and our sense is that while the markets have really not liked, or some segment of the market has really not liked the budget in the shorter term, but I think budget is looking is a fine balance between the most or the kind of requirement or the kind of ask which was there from the government. So from that perspective, I think our sense is that while the volatility would be there, but the market would eventually look to sort of recover some of these past losses. And I think if everything goes right, will not be surprised if we tend to sort of move towards closer to previous high levels as well. That's all I have to say. I'll be happy to sort of take questions.
Okay, thank you, Pankaj. Thanks for the detailed insight and sectoral coverage. Now, before we move to Q&A, let me now share with you some of the unique advantages of ICICI Direct, which may benefit you. One of the standout features of ICICI Direct is the 3-in-1 account structure, which integrates a saving account, trading account, and demat account. What makes this unique is that your money always remains in your saving account until you need it for trading. This means that even if you allocate money for trades, it doesn't move to the broker's pool account and you continue to earn interest on it. With ICICI Direct, your funds remain in your own saving account and you keep earning interest. This feature offers best control and transparency regarding your funds. Due to this, we have over 7 million clients and we manage 8.1 lakh crores of AUM for the clients. ICICI has some very unique features which you can use now in such kind of volatile times. So let me share with you about 2 or 3 such features. The first such feature is eATM. Now that's very unique in its own way. ICICI Direct offers eATM designated to provide quicker access to funds after selling stocks. Typically, it takes T+1 day for sale proceeds to be credited in your saving account. However, with eATM facility, up to 99% of sale amount can be credited to your account within 5 minutes of completing the transaction, and this comes to you without any extra cost. For example, if you sell 10 lakhs of stocks and choose the eATM option, you get up to 9,90,000 rupees in your account within the next 5 minutes. This can make a significant difference, especially on Friday when the settlement would usually push into the next week due to weekends. The eATM facility enhances liquidity for investors, providing a smoother and more efficient trading experience. Its key features are a maximum daily limit of 1 crore per day with Prime Plan at no extra cost, and it is available across 1,400 stocks listed on BSE and NSE both. Now, this was one feature. The next standout feature is the MTF. Budget has been volatile day, as you would witness, and you can expect price movements in stocks in times to come. In case you wish to buy any stock, but you are running out of funds, then you can use pay later option, which is also called margin trading facility on ICICI Direct platform for buying stocks. With pay later or MTF, You can buy stocks by just paying a small initial amount, which is called margin, with the rest of amount being funded by ICICI Direct. You can hold these shares for a period of 360 days with the ability to sell whenever you want during the holding period. ICICI Direct will charge you interest on the funded amount. The interest charges can go as low as 9.69% for selected prime plans. To understand how MTF works, you can check our trading calculator, which is MTF margin calculator. In the calculator, enter stocks details and see margin funding information. It is crystal clear. Features of MTF, the main portion is enhanced buying power. MTF enhances your buying power by allowing you to buy shares up to 3.3 times the initial fund value. It also gives you wide range of stocks to choose from, and we provide you with the ability to choose from 1200 stocks to buy using MTF. This ensures that you do not miss on your favorite stocks. The funding for MTF is provided at interest rate going as low as 0.0265% per day. In very simple terms, is 26 rupees 50 paisa per lakh. And that is one of the lowest in the market. The other one very unique feature which we have is one-click baskets. At times, you're not sure which stocks to buy. So one-click equity gives you the convenience of investing, monitoring and exiting equity stocks baskets at a click. You can diversify your investments in theme-based baskets of stocks and ETFs handpicked by our research team. The baskets have been curated after extensive analysis on both qualitative as well as quantitative parameters. You can create your own one-click equity baskets with the desired quantity and weightages. You can even buy certain one-click baskets through MTF with interest rate as low as 9.69%. The key benefits here is themes. Stock baskets with themes like defense, infra, IT, or you want to pick up Tata companies, or you can create your own curated basket. Wide array of choices, more than 30 baskets to choose from, which is well researched by both qualitative as well as quantitative parameters. There's no lock-in here. You can exit at any time without any charges, and there's zero extra cost. Get access to research recommendation curated stocks baskets at zero extra cost. So these are three key features which I have summarized. One is EATM, second is MTF facility, and third is one-click baskets, which can help you immensely in your journey towards attaining better wealth. So now we come to question and answers. Pankaj, what we have done is we have combined few of the questions which are in the chat box so that basically we can derive better meaning of the entire piece. The first question is, in the current scenario, there is increased volatility in global financial markets, given the geopolitical risk and policy uncertainty. Budget had a very important task to balance between maintaining the fiscal prudence and ensuring growth and consumption. Do you think the budget addressed the need for growth policies and macroeconomic stability?
So Manish, I also highlighted that budget is clearly a sort of a confluence of consumption push. Through personal income tax benefit, and there has been a bit of a moderation in the capex, with fiscal prudence sort of taking precedence over growth. But our sense is that the growth enabling factors such as overall capex allocation of about 11 lakh crores is a growth of 10%, which is quite modest. And it is a decent effort given the fact that fiscal prudence or fiscal focus cannot be let go. So from that perspective, I think the budget is a very well balanced between budget with the requirements of various sections of the economy.
Thanks, Pankaj. That was quite clear. Now, next question, interesting question. Ahead of budget session, the central government had assured to bless the poor and middle class of India and had mentioned that budget will give new energy and hope to the nation. So do you think this 12 lakh income tax rebate and such kind of things is adequate for overall budget? And do you think it does justice to the middle class of India?
Absolutely. I think the PM also stated that the budget is going to be a middle class budget with a strong flip to the overall consumption through tax relief. So I clearly believe that, and we've seen ample examples today in terms of market reaction as well. So you had segments like the entire consumption basket doing well, be it staples or be it consumer durables. Similarly, autos have done very well because for example, if someone is getting a benefit of say about 70,000-80,000 odd, which means that they can easily take an incremental loan of about 3 lakh, so which again can be used for various purposes, including for autos as well, or doing premiumization as well. So from that perspective, I think clearly, on top of it, I think we had ample signs of urban consumption not really sort of doing well over the past quarters, which has been also highlighted. So I think budget is clearly addressing the aspirations of the poor and the middle class.
Thanks, Pankaj. The next question is something which you talked about, which is capex. It says capex has been one of the major factors that has driven economic expansion over the past few years. Slower than expected infrastructure spending in recent times has raised concerns. Do you think the capital outlay in the budget will sustain growth?
I think, see, we also need to look at the base. So, for example, capital outlay of about 11.2 lakh crore is the same as what has been the year before. But in the first 9 months, what we have done is that we have spent only 7 lakh crores, right? And in the next 15 months, we are going to spend about 15 lakh crores. So you can understand that the incremental delta or the incremental capital expenditure which we are going to do. So from a absolute number perspective, it looks like there has been only 10% increase. But understand this, that first 9 months we have spent only 7 lakh crores, and next 15 months we are going to spend about 15 lakh crores. So from that perspective, I think while the numbers look less, but it is not going to disappoint the market the way we have seen the kind of disappointment. So while yes, more could have happened, but this is definitely a number which is quite satisfactory.
Okay, this is an interesting question. Now you have given some sectoral info. Which sectors, according to you, have been major beneficiaries of the budget? Any particular aspect that you would have wished that budget would have addressed and had got missed?
So sectors I already highlighted. So for example, see, from a consumption perspective, structurally, we like two sectors. One is the hotels and the hospitals. One largely because the government is going to push not only medical tourism, but tourism as well. And both these segments are a big beneficiary of that. And any kind of incremental discretionary spending, our senses will go into these segments. Besides, obviously, you'll have sectors like consumer durables and consumer staples, which are going to sort of benefit. Auto is another sector because auto is consumes a lot of discretionary income as well. So auto is another sector which is going to sort of benefit. So these are the sectors which are definitely going to benefit. But while the budget looks specifically positive for these sectors, but having said that, I think with fiscal deficit of 4.4 and a potential rate cut by RBI, I don't think the overall capital expenditure is going to see a big disappointment. The kind of reaction what we have seen today. So from that perspective, I think our sense is that while consumption might do a bit better in a near to medium term, I think eventually it is more of the capital expenditure which is going to do well. Because see, the multiplier effect of infra spending is a lot more higher, which I already highlighted.
Sure. Thanks, Pankaj. This is an interesting question. It says basically that budget was good, still market reacted negatively. How do you expect markets to interpret and react to the budget in days to come?
So, like I said, budget is not the only thing which impacts the market, and gone are the days when budget was the only factor or was the only time when the government used to do a policy announcement. A lot of policy announcement happened beyond budget as well, and which is why one should not really take budget as the only blueprint for the economy to sort of do well, because a lot of times a lot of announcements do happen beyond budget as well. Our sense is that as of now, global volatility or what Trump action or what kind of action Trump takes against other economies and the kind of dollar index is going to probably determine the kind of volatility in our markets. But once these eventually things settle down, I think the focus will come back to the domestic economy, and that is where we would expect markets to sort of do well. I don't think so. For today, it was a sort of a mixed reaction for the markets. But our sense is that once the market sort of digest further fine prints and understands the longer term picture, they're going to probably take this in a more positive way.
Okay, this is an interesting question, Pankaj, and you have covered some portion of it already. How do you think has this budget fared on direct and indirect taxes, given that they have given number of 1 lakh and some 26,000 crores? Are there any changes on tax on investments and the probable implication barring LRS?
I think, see, when you look at on the direct tax side, probably we might see a more elaborate direct tax code coming into picture sometime later. But I think from a overall taxation perspective, clearly we all know or we understand that most of the tax filers have moved to the new tax regime, and the benefits which have been announced today is definitely a good thing for people who have opted for that. And I think also the other aspect is that the tax simplification remains the core of overall measures, because a lot of other measures have been announced for tax simplification, and which is why I think that is a bigger key takeaway. And broadly, there has not been a major change in the taxes on investment, but nonetheless, I think there has been a clarification that the long-term gains from ULIP for held for one over a year, I think will be taxed at 12.5%. Earlier, there was some ambiguity about these. And I think overall sense is that while we also need to sort of read the fine print further, but I think the budget has done very well, especially in terms of simplifications.
Sure. Thanks, Pankaj. The next question, energy sector. So energy sector was a favorite sector before. So what are the trigger points according to you which can put it back in favor piece?
I think energy is becoming core to a number of sectors. So, for example, we as Indian consume about 20-25% of what the world consumes in terms of data. But in terms of data center capacity, I think we have about 3-4 odd percent. Now, data center consume a lot of power, a good amount of capex goes, and with a potential for AI going up or AI becoming mainstream. I think the overall consumption of data is going to be a lot more higher. On top of it, you have a big sector like automobile. Now, automobile is one of the biggest polluters, and our sense is that it's not domestically, but globally, there is a transition happening from IC engine to EV engine. And obviously, once you shift to that, you require good amount of power. And also, when you look at the source of generation of power is seeing a fundamental shift. So now you're going to generate more of power from a renewable energy source like say wind or solar, and which again is a sort of a power which fluctuates, and which is why a good amount of spending is required on the power and distribution side to manage or to handle those fluctuations. It's not something which is happening in India, but happening globally as well. And I think if India is able to sort of ride that, we can cater to our requirement, we can cater to the world requirement as well. And which is what also the PM also hinted, or FM also hinted. So from that perspective, while yes, it looks like that the overall allocation has not been so high, but our sense is that you have a good amount of capex, both from the private sector side and from the government side, especially on the renewable side. And I think this is something which is irreversible. And our sense is that power is going to remain a center or a core theme for a good period of time, at least for a decade.
Thanks, Pankaj. Now there's an interesting question on rupee dollar. It says, how will the rupee depreciation affect our economy overall, and which sectors will get mostly impacted? Obviously, software is one of the important one, but besides that.
One is, see, we need to understand that as of now, the rupees depreciation is largely pegged to the kind of depreciation we see in yuan. Because we all know that when the Trump had come in, he had announced that he's going to levy about 60% kind of a tariff on China. And China obviously is one of the biggest trade partners for US. And China, in order to protect their economy, were looking or were allowing their currency to sort of depreciate. Now, since we are competing with China in number of segments and pockets, we can't really allow our currency to remain as it is, and which is why our currency also has been trending lower in line with the overall decline in the Chinese currency. And our sense is that whenever this issue gets sorted between US and China, I think our currency will also become stable. So structural decline in our currency at best could be about 2-3% odd. That is what one should take. Otherwise, I think our sense is that in the near term, largely, I think Trump is pushing for a 10% kind of a tariff hike, which is relatively a lot lesser than what he has said earlier. So, in the near term, our sense is that the dollar index has sort of topped out at about 110. But never say never. Trump is known for his volatile comment. So, what I would want to believe is that the worst is largely behind us, and I think things are going to probably stabilize in a month or two. And when that happens, like Naren also highlighted, one will start getting the inflows, especially in large caps like say BFSI or oil and gas. And also it is going to sort of benefit some of the other sectors like say pharma or IT to some extent. But I think both these segments really do not derive bigger benefit now, because our sense is structurally currency depreciation is going to be in the range of 2 to 3 odd %, barring the recent volatility.
Thanks, Pankaj. This is an interesting one. Now that in this budget, there'll be more money in the hands of basically salaried class. Will it mean more inflationary trends of FFC goods?
So when you look at the core inflation, last, I think about 10, 11 odd months, it's quite stable. I think the volatility what we see in our inflation is more to do with the vegetable and the other cereal prices getting impacted, especially when you have periods like monsoon. Otherwise, our inflation has been quite stable, and our sense is that with a big economy like China not doing so well, a lot of industrial commodities could or may not really see much of a sharp hike. And I think monsoon has been very kind to us. So from that perspective, also our sense is that in general, inflation is not a big worry, and which is why the RBI's projection for next year is also quite sort of stable at about 4.5% kind of inflation.
Sure. Thanks, Pankaj. Thanks, Naren. Thanks, all our esteemed guests. So have a wonderful evening, and we conclude the session with this, and have a fantastic weekend ahead. Thank you.
Thank you so much.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.